Hi, welcome to Market Minute. We think we're in an economic slowdown phase for the stock market, and that's typically not good for stocks. And then we think the market is in a show me stage. Rather than buying a dip, you got to show me you can get back above the 200-day and stay there and start moving upward again. So the trend of the market's down. The trend has to get back up and start going in the right direction. So risks. So we think there's long-term problems that need to be fixed, and we think the Trump plan actually fix a lot of those problems. So in his own words, it's a brief economic pain is worth the long-term gain. We see that, but to get there, there's obviously some issues to resolve. The government cuts, the big government cuts, is going to feel like driving a fast sports car and hitting a massive pothole. It hurts. You really feel it. And we think you're going to really feel the slowdown that's happening in the overall economy. The consumer slowing, 2 months, two back-to-back months of slower or negative consumer spending. And we don't think it's going to get any better in March, but we're going to watch that closely. So there's negative expectations regarding the first quarter. We don't think the market's buying into a big negative print on the first quarter, but it sure seems to be looking that direction. Bond yields have come down, so that's supportive. That's a good thing. We like that. We need to come down some more to really be supportive of higher valuations than the high valuations that are currently. And the rotation is on. The only problem with the rotation is some of those sectors, they're just cheap. The fundamentals aren't improving yet. So we need lower interest rates and that stimulus put in place of Trump's plan, and that movement of dollars spent in the economy from the government side to the private side. So look at these. You'll see this in our hard copy of Market in a minute. But look at these returns year to date, and this is through Friday. Monday was really ugly, but you can see the trends here. Technology, consumer discretionary. Now, a good part of that is also Tesla and Amazon. So just keep that in mind. So it's tech and tech related here. That's really not working out well. Consumer staples up nicely. Healthcare. This is one of our major calls. Consumer staples and healthcare this year. They're working out very nicely. And most of the sectors are up except for the tech sector. The tech sector was awful on Monday. You see some of the stocks like Meta down 4%, Amazon only down 2%, Google down 4.5%. We like Google. I would be looking at that one. Apple down almost 5%, Nvidia off 5%. So it was a really bloody day in technology. We're seeing that rotation occur. Some of the consumer staple stocks were up nicely. Some of the healthcare stocks up as well. So we're starting to think about the next cycle. So we need to see interest rates down lower to get the interest sensitive parts of the market moving again. And housing's been crushed. The housing stock's down really hard. So we're really curious about those. If we get rates coming down, you get that nice movement in those early cycle stocks, including the small cap stocks. So we think tech has peaked. We think the expectations are high, really high, for AI spending going into next year. That has to come down. We think that's got to show kind of a flat to negative. I think probably negative is more likely, negative spending on AI infrastructure. And then you'll start to see the stocks probably work again. The valuations of the S&P 500 at 20.7. So it's because of all the mega cap technology stocks that's supporting that high valuation. The average stock's only about 17 times earnings. So that's actually not all that bad. Now in a very mild recession, we'd see maybe 15 times earnings. In a severe recession, we'd be 10 to 12 times earnings. So you can see there's still more downside. Tariffs. Tariffs are a bigger deal for the stock market than they are the economy. So you have to watch where you step. And the sectors that have really large exposure to international is technology. So watch your step there. Canada and Mexico, they need to find a solution. Canada and Mexico, you need to figure things out. Otherwise, your economy is going to be decimated. Technology and technology related stocks comprise now about 46% of the S&P 500. It's down a little bit, but still really high. And we think that has to come down, and it's still in a big way to make the index more attractively valued and take the risk off as well. So we think there's a ways to go, and I would continue to avoid having any major exposure to technology and pick things off here and there as they come into good prices. Again, I mentioned Google. We like that one. I like the fundamentals at Meta as well. Not the stock yet, but the fundamentals. The technicals, they're all negative. There's still more downside. A 10% correction, the S&P 500 is about 55.32. So there's still a ways to go, a little bit ways to go to get a correction on the books. And we may be headed for a little bit more of a correction. If we enter that recession, it's going to go down more than 20%. So we might be headed that direction. The geopolitical risk, okay? We may be coming to an end of the war in Russia, or Russia-Ukraine war. That may be coming to an end. But what concerns us is China's watching this, how Trump's handling this. He wants to resolve it. We think that gives China, the green light to maybe do something. So we don't like how this is playing out. Russia needs to be punished, severely punished. And I know he's trying to resolve things there. But then if you just resolve it with no damage to Russia, then China's just going to take Taiwan over. So we want to see how it plays out. If Taiwan is a problem, if China goes after Taiwan, becomes a problem, we think there's some technology stocks that look interesting. We'll cover that at the end. And Iran told Trump, no deal. So they're not going there. And I think that's really bad news for Iran. And I would look for some sort of taken out of the nuclear sites in the not too distant future. This is kind of what we thought all along when Trump came in office. We think it's playing out. So we might see a spike in oil prices in the short term. So there are a lot of issues, lots of issues. The market's kind of coming to grips with these issues. It's working through it. So this is a good process. It may be down 10% more from where we are currently before it ultimately bottoms out, or maybe even more, but it's working through that process. The thing to do is to look at the technicals, and we'll cover that in a second. The economic cycle, as I mentioned, we're in this slowdown mode. Ultimately you want to be down here at the bottom after a recession and really get aggressive, buy those small cap stocks and early cycle stocks and value stocks. They're going to perform really well after we get through this recession or whatever the slowdown is. And so we've worked through all this where the expectations got really high. Now the expectations are being brought in. And if it's just a slowdown, then we're probably not too far from a bottom. I think tech still has to go lower, but I think it's more than a slowdown. We may have a couple quarters of negative GDP growth. Don't know exactly, but cutting so much government out, which is such a large part of the economy, and grew so vastly under Biden, there's a lot to cut there. You cut $1 trillion out, you're looking at a very big decline in government spending, and that will impact the economy unless there's some sort of offset. We're not getting the offset at this point. So there could be another shoe to drop, and maybe we go into probably a mild recession this year or later this year. So at the moment, we're factoring in to the markets. We're in that slowdown phase. We're going to see companies disappoint. And so those companies that are economically sensitive or just with too high expectations think they're going to continue to come down. Delta reported a guide down on Monday. it's hitting the stock pretty hard. So we think there's more to come of circumstances like that. Now the technicals. Okay, here are the major indexes. S&P, nicely below the 200-day. Triple Q is below the 200-day. Russell 2000 well below the 200-day. So what we want to see, okay, is that these shorter term moving averages, this is ultimately what we want to see is that they come down below the 200-day, and the market gets kind of cleansed. And that way, as it goes back up, you have the shorter term moving averages serving as support for the market as it climbs back above the 50-day, the 200-day. So as this goes, so why do we think it's a show me market? Well, it's got to get back above the 200-day, otherwise we're in a downtrend. This is a sell signal. This is a very reliable sell signal. So below the 200-day, you want to be as defensive as possible. And we're seeing that in all the indexes. Now the Russell 2000 is getting really nicely overdone. That's the one we'd probably put some money into at some point on more of a pullback than what it is currently. But that's the one we want to go to as long as we're seeing that the interest rates are starting to drop on the 10-year Treasury as well. The yields on the 10-year Treasury dropping. The VIX is up. So this is the volatility index. This is the measurement of fear. There's a fair amount of fear in the overall markets at this point, but it could be a lot more. So it's about 28. We think it could go to over 40, and that would give a good sign that maybe things are overly done on the downside. So we are oversold. We got a lot of negative sentiment. The markets are down below their 200-day, but it's really early in the process. So if you're going to turn around and go up again, you got to show me you can go above that 200-day. Individual stocks. We got on Monday we got Checkpoint being bought out. So anybody that's followed our Mark in a Minute over the years known that we've liked Checkpoint, and it's been a long time. It's been a process, and so finally getting that drug approved, and now it's being acquired. The stock was up about 61% on Monday. Hallelujah, man. Hallelujah. So finally get that one going out of our emerging healthcare strategy at a nice premium. And then some unique stocks, okay, to be thinking about. So Grail and Avanex, okay, we think these are two really unique healthcare companies. Grail, as you know, it has the cancer test blood tests on over 50 different cancers. It's going through the process of getting legitimized by doing an FDA trial so they can get the insurance reimbursement. They're doing about 125 or 130 million in revenues currently. We'd put a 10 multiple on that as a valuation. Now the stock so that would be about $1.3 billion valuation for the stock, 10 times revenues. Now it's about 1.1 billion market cap. So that's kind of interesting. It's getting some value back into it. Just keep in mind we bought this in the mid-ish teens, mid to low teens. The stocks moved up. It got to intraday up to as high as 60, and it's pulled back to about 30. It got to as high as 26% in our emerging healthcare strategy, and we carved it back to about a 10% position. So it's getting attractive again. On any flush down, we want to own that in a big way. Avanex is another one of these, going to be an incredible mover over time. They've got an Alzheimer's drug. It's going to be a huge drug. If it's approved, it's going to be just huge. We see no reason why it should not get approved over time. So they file for approval in Europe. Likely see the same thing happen in the U.S. sometime later this year. They'll file for approval. So this is actually a drug that prevents Alzheimer's from occurring and slows it down versus just cleaning up the mess after you already had Alzheimer's. It's not all that helpful, the two drugs that are approved already on the market. So Gap is turning. They've brought in new management. They're kicking butt. they're really improving the operations and the quality of the merchandise, the fashion. It's all really going well for them. So we think that this company is turning. We think that there's a double in this company over time. It's trading at about 10 times earnings. There's no reason with growth and the multiple expanding, you can't get a double out of the stock. So for me, this is the type of stock that I want to buy. Even with the weak economy, they showed really good comps. So there's something going on here. Actually, Target is actually improving too. So it's been in the doghouse for a while. Just by the nature of the regression of the numbers, just they went down and they're starting to reaccelerate because they went slow and now it's just starting to improve a little bit. So we think that they are actually getting their act together as well. And the valuation discount versus Walmart and Costco is massive. So if this stock could get on a roll here with some more improvement maybe in the back half of this year, we think that this has a really good move in it as well. Google, the risk reward on Google is really promising. They're in all the right sectors of the market. The government wants them to divest Chrome. We don't think that really is a negative, actually. And so maybe it'll bring some light to the valuation of that business. And then lastly, Intel. We think Intel is a really good hedge on China coming into Taiwan. If that would occur, Intel is up massively. And there's value in that stock. I can't believe I'm saying this. We've been out of it for a long time, starting to repurchase it. Intel is interesting. They bought Altera back in 2017. Altera is a great company. These field programmable memory chips. That's probably a significant valuation part of the overall value for Intel. So we like Intel as a contrarian play, as something that probably can't get any worse than it already is. So at $20, it looks really cheap on revenues, and at some point in time, that valuation is going to be realized. Thank you very much. Just keep in mind, we manage money for individuals and institutional investors. We do tactical and what's called loss-averse investing, and then we specialize also in emerging healthcare. So if you ever want our help, just let us know. Ping us. If you ever have a question, ping us. We're always here to help. Take care.